All right, good morning, everyone. Thank you for attending today. It's a couple minutes after 1 o'clock Central here, so I'll get going, even though I know we have a couple people getting on here, but I know your time is valuable, so I will get started here. Well, my name is Nick Ohlson here. I'm a marketing director here over at the Ohlson Group. For those of you not familiar with our company here, we are a national agency that we focus on the annuity, life, and long-term care alternative markets. And what we really try to do, not only to bring you new things on the marketing, research, and education fronts, but we also try to put you in front of pre-qualified prospects under favorable circumstances on a regular basis. So whereas we don't want to just sit here and talk about product features, which I know a lot of you guys could just get an agent guide on these and figure that stuff out for yourself, but we want to talk about really kind of what's going on in this marketplace, kind of frame it up for you, tell you, of course, about the product details, but then on all these webinars, what we really want to show is how our agents are using these concepts with success around the country in their different markets. So everybody's on mute only right now because we do have a very large number of people on here, but we will be doing questions at the end. Of course, if we don't get to you, please feel free to call us at 877-844-0900, and one of our marketing consultants will definitely be able to answer those questions for you. All right. Well, what we're talking about today is this long-term care hybrid marketplace. And I assume those of you that are on this call realize what that means, or you probably wouldn't be on here, but we're talking about different annuity and life insurance contracts that have some type of long-term care insurance component to them. Some of these are official long-term care riders where they're technically considered long-term care insurance coupled with the program. And some of them are just these other types of riders that aren't technically qualified as long-term care riders, but still provide long-term care type of benefits. So, the things we're going to cover today are the state of the industry, government and insurance company actions, what those groups have done to make this market even bigger, the types of products in the marketplace, case studies for that, and then, of course, marketing strategies. How do you get in front of new prospects and go back to your current clients and present this idea? All right, well, let's look at the state of the industry here. First of all, everybody knows we have this aging population base right now. I assume every one of these senior market calls that you guys are on, everybody talks about the aging boomers and how there are so many billions, trillions of boomers that are going to be, retiring soon, are going to need health care, are going to need potential long-term care type of services here, and how there's this huge group of money that's going to be passed down, and people are going to need advisors. Well, okay, everybody realizes this is happening, and the need for long-term care insurance is up, but sales are down of traditional long-term care. So that is the real weird component here, where you have the need up, but sales are down. Why is that? Well, a lot of these clients, they know they need this type of insurance, but you know what? A lot of their investment accounts have just taken a big hit over the last couple of years, and they're still down, and a lot of people are being laid off. So one of the first things maybe to go is that, $4,000 a year long-term care insurance premium. Or maybe people decide that they need to get this too late, or they can't qualify, or they just look at those premiums and think, you know what, they're just too expensive right now. So we're going to talk about ways around that, how to still get them coverage. Also, we have tougher Medicaid laws here. For those of you that work with us and know us, you know that we are one of the biggest experts in Medicaid planning and veterans benefit planning as well across the country, where we help our agents to help their clients to obtain Medicaid benefits for long-term care and to get those veterans benefits that they should be entitled to as well. But laws are getting tougher. It's tougher to qualify for Medicaid, so we have to find other ways to do this. And, of course, we always try to find other ways if you can do that in a pre-need type of situation without getting into a crisis planning situation. And everybody also tells you, too, I could list a million different sources here, but people all pretty much know that working in this marketplace that the two biggest concerns for retiree clients are outliving their money and being diagnosed with some type of catastrophic or chronic illness and needing long-term health care. So with this type of long-term care insurance, that's how we can help prevent those two type of situations. Let's look at some of the insurance company developments here. They've come out over the last 5-10 years with a lot more of these life and annuity contracts with long-term care riders. Now, opposed to the client that looks at an expensive long-term care insurance premium when they're 65 years old and thinking, I know I need this type of coverage, but I look at it as a use it or lose it situation. If I'm not, if I never use this long-term care insurance, then I've just been wasting this money. Well, we know that's really not true. I mean, people buy homeowners insurance, they buy auto insurance, to make these type of coverages, and they don't even think about it. They think, hey, this is something I need to protect against. But unfortunately, in the client's minds, a lot of them see it as this use it or lose it situation and don't attribute it to like those other type of, insurance that they buy. There are also these accelerated death benefits on life insurance that help pay out those that death benefit to the client if they qualify for long-term care reimbursement. Then we also have these annuity value multipliers here, where you can get double or triple the value of your deferred annuity if you need long-term care assistance as well. So we're going to go over a number of those products, those types of products, and the companies that represent them. Let's look at some government developments. Well, the biggest one was the Pension Protection Act that went into effect January of this year. Now, just like any government act, there are pages and pages of different things that happened out of this. But the main ones that we look at pertaining to this market is that long-term care rider payouts to be used for long-term care services come out income tax-free to the client. This is for any of these annuity and life products that have these qualified long-term care riders on them. Also, for any of these fees and charges that are attributable to the long-term care riders, when they're deducted from the client's account, they're not considered taxable distributions. So it will deduct from the client's account, but won't be a taxable event like a lot of them were in the past. This also allows a big opportunity for 1035 exchanges from non-qualified annuities into one of these linked benefit annuities without there being taxes. Okay, of course, 1035 exchange, means there are no taxes when you exchange it over there. But even if you have a big cost basis from the other annuity, when you roll it over, you can roll it over without any taxes being owed. And then if you qualify for long-term care payments from the rider later on, you are not taxed on those distributions either. So Uncle Sam has made, for once, a loophole that they encourage people to take to get out of ever having to pay the taxes that should be owed on these tax-deferred annuities. So that makes a big sales opportunity. Now, one thing I want everybody to know, too, you must have, on a state-by-state basis, your long-term care continuing education credits in order to sell these products that have the true long-term care riders on them. So it's different by state. I think Indiana is 8 extra hours for this, so be sure to check with your state what you need in that area. So these two things together, these products that have been developed and the government really incentivizing the clients, has made a great opportunity for the client and for you, the advisor. Let's look at a few different types of what we call these hybrid products. We're going to look at these deferred annuities that have long-term care riders, life insurance products with long-term care riders, And then we're going to look at some of these other type of products, these simplified issue life products, either single premium or multiple premium situations that have these chronic illness type of benefits or accelerated death benefit riders. Now, those don't qualify under the Pension Protection Act, but those benefits are still paid out income tax-free to the client because they're paid as accelerated death benefits. So those have always been tax-free because of other rulings. So, but it's just a little bit different from the Pension Protection Act. But hey, it still avoids the tax on these distributions, so it works for what we're trying to do. Also, we're going to look at a different area that kind of goes into these. Some of these different fixed and indexed annuities that have guaranteed lifetime withdrawal benefits that provide for increased guaranteed income for life with a qualifying health event, whether it's not being able to perform 2 activities of daily living or maybe going into a nursing home. So these are the ones we're going to talk about today. Let's start, for an example, with this new annuity with the long-term care rider. The big one that came here on the market recently is the Genworth Total Living Coverage Annuity. Now, it is a 7-year fixed annuity, 7 years of surrender charges. The rate right now is anywhere between 3.8 and 3.25 for the first year, depending upon the amount of premium you put in there. But it does have a 3% minimum guarantee. Now, the way that this works, you pick a few different options up front. You either pick a multiplier of 1.5, 2, or 3 times the annuity premium that you put in. Quite simply, if you pick the 3 times benefit and you put in $100,000, you will have a total pool of $300,000 to draw off of for all forms of covered long-term care. And there either is a 4 or a 6-year payout you can choose to take. And you have inflation options you can put on it, 3 or 5%. Now, there are certain combinations you can and cannot do with this, but you know, when you have a certain client at a certain age with a certain amount of money, we can show you the options on how this would work. Now, it's simplified underwriting, so there are no exams, but this is not a place to go for all your clients that have been declined for long-term care insurance, because you still have to pass a lot of these gatekeeper questions and you know, major things that would disqualify you from long-term care insurance, you know, like dementia, Alzheimer's, and things like that, you know, will knock the clients out on this too. So they have a very good underwriting guide that lays out you know, illnesses that you couldn't have within the last, let's say, 3 years, 5 years, 7 years, 10 years. So when you're sitting down with a client before you sign them up, you should know pretty much if they're going to be a candidate for this. There's only a 1-year wait on benefits with this. Now, I know a lot of other products in the marketplace, there's underwriting and you have to wait 3 to 5 years before you're eligible for benefits. Well, with this, in most states, it's only a 1-year wait. Some of them, like California, for example, I know, they do have a 2-year wait on this. But still, you're eligible for benefits pretty quickly after the policy's issued. It will issue through age 79. That's the last thing to do. They do age last birthday. And it's a street commission of 4.5%. And it does reduce at older ages. And we will be going through, of course, case examples with this later. Long-term care rider. One of the main ones we use for this is the John Hancock Protection Universal Life G. So on the main chassis of the product, it's a no-lapse guarantee universal life contract, meaning as long as you make that promised no-lapse guarantee premium, that the death benefit will be guaranteed through age 120. Now, they have this optional long-term care rider you can put on it, where it allows you to take up to a monthly maximum benefit of either 1%, 2%, or 4% of that face amount. And you choose that up front, and of course the fee and the death benefit are affected by how large of a benefit you choose to take. So you can take up to that Also, they have a continuation rider available that would pay up to 2 times the death benefit. That would kick in after your own death benefit has been extinguished. Let's say, for example, you have a $300,000 face value, $300,000 death benefit, and you choose the maximum continuation rider. Well, technically, you would have $600,000 of total long-term care benefits that you could pull off of in that pool of money. You have all types of payment options available. You can do a single pay, 5 pay, 10 pay, or lifetime continuous pay, just like traditional universal life insurance. And of course, John Hancock is known to many clients, and they are they're A+ rated with AM Best. Now let's look at some of the other type of products that aren't technically long-term care qualified riders, but they still have this tax-free payout because they're accelerated death benefit riders. One of our main capital transfer products for a few years now has been the Sagicor fixed indexed single premium whole life product. So it's simplified issue, single premium only. They issue everybody standard that's within Table 4. So there's a telephone interview, and the application is all they'll take. There are no exams required to get underwritten for this product. They have this very powerful money-back guarantee, this true return of premium guarantee, which basically means that whatever premium you put in the contract, the surrender value will never be below what that premium is that you put in. So it really helps to cut down on any buyer's remorse where they're thinking, you know what, this product sounds good, but what happens if I need my money? Well, with that built-in ROP guarantee, you have access to that at any time. As you can see, this is kind of an annuity-like product where it has a 10% premium bonus right up front to the cash value. So it'll help to make up for any surrender charges that you paid moving the money over, or possibly any taxes you had moving from maybe an annuity over into life insurance here. Now let's get to the long-term care component. It's got what they call their chronic illness rider, which pays all but $25,000 of the death benefit. They keep $25 grand in the pot there for a residual death benefit. They take all but 25, divide that by 33, and that becomes your monthly benefit for up to 33 months if the client cannot perform 2 activities of daily living. And once again, that does come out income tax-free for the client. This product has an 8% commission based on the single premium. It does reduce at older ages and will issue through age 85. Now, for those of you that want a fixed product, or maybe because of broker-dealer constrictions, or maybe a captive group you're with, you can't do anything on the index side, they do have a fixed version called the interest-sensitive single premium whole life, which will actually issue through age 90. It's just a fixed interest rate and still has that chronic illness rider available for long-term care-like situations. Where the client is not available to do a single premium type of situation, Sagicor also has a 7-pay indexed whole life, where you have 7 equal payments. It's paid up after 7 years, and still has that chronic illness rider associated with it. They also had approved a SPIA that we can do as a 7-year certain, where if you want to roll, let's say, an existing annuity or IRA into Sagicor's SPIA, you can set up a 7-year certain payout that will be paid directly into this 7-pay indexed whole life. So you only owe 1/7 of the taxes each year over those 7 years. So we'll talk about situations and the case studies where that is applicable as well. Now the last one we'll talk about are these guaranteed lifetime withdrawal benefits that have increased payouts for LTC. One of the main ones we used is with RBC. Now they have this whole enhanced choice portfolio where they have products that are 8 and 10 years in surrender charges, 8, 10, and 12 years in surrender charges, You can get up to a 5% premium bonus. Commissions are up to 8%. But they're all eligible to put on this enhanced GLWB rider. Now this gives you guaranteed income for life, just like those other GLWB riders are. They give you a 7.5% compounded growth on the income account for up to 10 years. They have competitive withdrawal rates. For example, at age 60, you qualify for a 5% withdrawal. At age 70, it's 6%. But the thing that makes this one different is the income is increased by 50% if the client cannot perform 2 activities of daily living. So let's say the client qualified under the normal withdrawal rate of a $10,000 per year benefit for income, and they're withdrawing that every year. Well, if they cannot perform 2 activities of daily living, that $10,000 now becomes $15,000 for life, as long as the client should live and as long as they need assistance with those 2 ADLs. And of course, with all these GLWBs, even if your client's account runs out of money, that income will continue to be paid as long as the client lives. This is a great way to help out for income planning, for getting an income the client can never outlive, and increasing that if they have some type of illness that makes them need more money. Now, I didn't mention in here too, but Aviva also has a product that will double the client's income amount if they go into a full nursing home. So it's not as liberal as their RBC, but it does give you double if you go into the full-blown nursing home. But the nice thing with RBC is here, it's for home health care and other things too, they would get the increase in benefits on this one. And there's no underwriting on this. There's just a 5-year waiting period before you can claim that extra 50% on income. All right. Well, let's look at some real-life situations here, and these are real cases that I've worked on with my agents around the country here that we'll go through. The first one is talking about an annuity 1035 exchange case where we're showing annuity money being moved into an annuity with a long-term care rider. We're also going to be talking about this 5% withdrawal solution, taking 5% out of an existing account every year to fund a life contract that has a long-term care provision. We'll also talk about a variable annuity rescue situation. We'll also talk about a Roth conversion alternative, which I think is very powerful to show how we can give the client some income tax-free money to pass on and also give them potential long-term care benefits from that. Also, we'll talk about income planning with this long-term care provision. Excuse me. All right, first one, the annuity 1035 exchange. Situation, we have a 67-year-old male client. This guy owns a fixed annuity worth $123,000. Now, the cost basis on this is $42,000. So this client had had this annuity for a number of years. He had already 1035 exchanged it one time over and continued to defer the taxes that were owed. So right now he has $81,000 of taxable gain. Well, this is nice that he's benefited from this gain the entire time without having to pay taxes. But, Uncle Sam, in the most cases, is always going to say, hey, that's great, you can enjoy it now. You're going to pay it, or your heirs are going to pay it whenever you take this money out. And they want some type of long-term care coverage, but this 67-year-old guy was offered a traditional long-term care policy, just didn't want to pay the premiums, didn't like the use it or to lose it situation. Well, how can we help him? Well, what we did was we 1035 exchanged that $123,000 over to this Genworth annuity with a long-term care rider. And what we did, we picked a 3 times benefit for long-term care, which gave him a $369 total pot of long-term care coverage, which he could take out as quickly as over 6 years. Now, when you do the 3 times benefit, for example, it defaults to a 6-year minimum payout. And if he does qualify for these long-term care payments and starts drawing out this $51.25 per month, $5,125 per month, that's the maximum they can take out per month, that's coming out all income tax-free, regardless of the fact that he had over $80,000 of taxable growth built up inside this annuity. With this, we tripled his account value for long-term care. We got him out of this over 80 grand of taxable income he was going to have to recognize, and we helped protect the rest of his nest egg by just using this 123 grand to turn that into 369 so that he didn't have to dig into those other funds that he needed for income, those other funds that he wanted to leave his heirs, and whatever else he wanted to use those monies for. So this client was very happy here, and hey, if he never takes out that money for long-term care, he was in the same situation he was before, and he'll owe the taxes there. But he's put into a good situation here with a good way to draw money for those benefits. All right. Let's look at a different situation here that I did recently with one of my agents. I believe this one was in Michigan, I think. This is a life with long-term care situation, and what we always call our 5% solution. For those of you that have seen our videos and maybe have been on these webinars before, we always talk about this 5% solution drawing off of clients' existing annuities or investment accounts at a tune of 5% per year off of maybe a chunk of lazy money that they don't need but they want to kind of keep intact. We can safely take out 5% per year to make sure we're under that 10% withdrawal corridor to fund life insurance that will help pay any taxes that are owed from other qualified or non-qualified monies that will be taxable when the client passes on. So let me show you how this works. In this situation, we had a 64-year-old female that had an existing annuity worth just over $107,000. This client wanted long-term care type of coverage, but also wanted an opportunity to pass on funds to the client in a or to the heirs in a tax-efficient manner if she didn't need it. Well, it was almost like she had read the brochure on one of these products of John Hancock, because she asked for, is there a long-term care product that has some type of benefit for my heirs if I don't use the money? Well, in fact, there was. What we showed her was to take that 5% withdrawal each year to fund a life insurance contract that has a long-term care rider. Well, 5% off of that 107 grand was roughly $5,300 a year. Well, that bought the client a $300,000 guaranteed no-lapse death benefit life insurance contract, which is pretty strong on its own. But what we did, we put on this long-term care rider. We chose the 2% monthly benefit. Now, if you recall with John Hancock, you can do a 2%, 4%, or a 1% maximum monthly benefit. But we found that the 2% was fine because it gave her $6,000 per month, which she can take out as quickly as up to 50 months. We had the option to do a continuation rider off of that. It reduced her face a little bit more. She decided that this was a fine deal, just doing the 2% per month for $6,000 a month up to 50 months. So if she doesn't ever need it, $300,000 go income tax-free to the heirs. And then if she does need this, then $6,000 per month is just deducted from her death benefit, dollar for dollar, and of course, once again, comes out income tax-free under the Pension Protection Act. All right. Moving on here, let's talk about a variable annuity rescue situation here. We had a 71-year-old male that had $167,000 in a variable annuity that, situations had changed, but he said that, hey, you know what, this guy I think was about 9 years older than his wife, and he wanted to leave this money to his wife after he passed on. And he'd been up and down and all around in the market. Some of it had come back, but he's 71 years old, and he said, you know what, my risk tolerance just isn't like it was, isn't like it used to be, and he wanted to move to more of a safe money type of alternative. And he was also thinking, you know what, I don't really have any long-term care insurance, and, you know, I want to leave money to my wife. If I get sick and I don't have anything to take care of these long-term care expenses, I might end up leaving nothing to my wife here. So how can I use this same pot of money maybe to protect the rest of my nest egg if I do get sick? Well, what we showed him is that we wanted to buy this Sagicor fixed indexed single premium whole life product. Now that $167,000 of premium bought him $263,000 of guaranteed death benefit all the way to 120, age 120. So we had some good leverage there, and this is on a simplified underwriting product. That's just a telephone interview at age 71 male. And he's got his hand on the back door there, where, you know, he has that return of premium feature that guarantees a minimum surrender value of that $167,000 at any time. If he wants his money back, he can have it. But the big kicker that really sealed the deal here was the chronic illness rider. That under this policy with the $263,000 face amount would pay him $7,200 a month for up to 33 months if he came to the point where he couldn't perform 2 activities of daily living. And being that that's under the accelerated death benefit provision, it comes out tax-free to him, and that as those are paid out every month, it just reduces the face amount dollar for dollar. And if he dies after, let's say, 2 months, you know, he's taken out less than $15,000 of that. So that $15,000 is just deducted from the death benefit, and his wife would still get a sizable tax-free death benefit off of this. All right, let's look at another deal here too. That's a Roth conversion alternative. Now, of course, the Roth conversion market has been a big, you know, there have been tons of webinars, trainings on this over the last year, and we've done some of them too, and there are a lot of great situations for this. But what we found in a lot of cases when it comes down to the client wanting to pay the tax, even though with these new rules for Roth conversions, that if you convert to a traditional IRA now, you're going to owe the taxes on that full amount of the IRA, but you can stretch it over 2 years. But still, the matter of fact here is that clients just aren't doing this as much as we thought they were going to pay that tax, even over 2 years. So we have some good alternatives here. Let me tell you how. We have a 70-year-old woman. She had $181,000 in an IRA. She was with one of my agents that actually talked about the Roth conversion in his seminar. That's why she booked the appointment. But when we broke it down, she didn't want to owe roughly 90 grand, you know, income tax on an extra 90 grand per year over the next 2 years, but still wanted to put it into, you know, a tax-free situation for her heirs and wanted to pay these taxes somehow, maybe until they, you know, before they started getting even bigger. And wasn't into the idea of paying required or taking the required minimum distributions later on this year because she didn't need the money. And she also said, you know, through the seminar that, yeah, I do have a concern with long-term care protection as well. Well, what we suggested, and what she ended up taking, was said, okay, here's what we're going to do. We're going to transfer $181,000 into a SPIA with Sagicor. Now we have a tax-free IRA transfer. And we're going to make this a 7-year certain. And we're going to assign each one of those annual payments, which were a little over $28,000 per year, to Sagicor to buy this 7-pay indexed whole life. Now the nice thing is with this, the way Sagicor has it set up, is that the check doesn't have to go back to the client and the client has to remember to pay the insurance premium. You can just assign each one of those annual payments to go directly to that insurance contract. So she could swallow a little bit more easily this $28,000 of extraordinary income she was going to have to claim on her tax return each year versus taking $90,000 over the next 2 years. So she only owes income tax, of course, on that $28,000 every year. And from day one, right when that first premium goes in, she has a death benefit of over $278,000. And of course, that's going to be an income tax-free death benefit. Now, one of the things too, not that the client wants to die early, but if they only made one premium payment into this product, and they passed away, the heirs would get the full $278,000 death benefit plus the remaining SPIA payments that would be paying from the remainder of the 6 years on that SPIA. But after 7 years, it's fully paid up. That $278,000 of death benefit is guaranteed to age 120, and it has the availability of this chronic illness rider that under this situation would pay the maximum $7,576 per month for up to 33 months income tax-free if the client got sick. Now, I don't know about you, but if you look at all the features here, what we did, spreading out taxes over 7 years, giving an immediate leveraged income tax-free death benefit with a $7,500 a month income tax-free benefit for long-term care, this really beats the heck out of a Roth conversion here. So this really resonated well with the client, and we kind of almost fell into this, by accident, the agent and I did, about making this like a Roth conversion, alternative here. All right, our last case example here, then we'll get into some marketing things. But let's talk about this income planning situation where we get a long-term care provision. Now, we had talked before about the two main issues of clients right now that are in the retiree market are outliving their money, or more realistically, having to live on a smaller amount of income than they anticipated, and also having some long-term care health issue that's going to deplete their savings and all the money that they needed for income. So the two kind of go hand in hand. So it's nice that some of these insurance companies have come out with these riders that have paired the two. Let's look at a situation. We had a 67-year-old male with $312,000. And he was thinking, okay, in 5 years I'm going to be retired, and I want to generate the most guaranteed income possible that I can starting at age 72. But he wanted to retain control of the funds. Somebody had talked to him about annuitization before, where it's kicked on at a certain level like a pension, but he can't stop and start it. He can't get at the pool of money. He wasn't into that idea. He wanted to retain control of the funds. And he also wanted some extra money out of there if he needed help with, long-term care. Well, here's what we proposed. That he buy the RBC Enhanced Choice 10 indexed annuity with a 5% premium bonus with the enhanced guaranteed lifetime withdrawal benefit. Now, we know we had 5 years of deferral, right? So we give him a 7.5% compounded annual growth on the income account. So after 5 years, that grew to $474,000. And at age 72, he qualified for a 6% guaranteed withdrawal for life, even if the account value goes all the way down to 0. So that was $28,000 roughly that he was guaranteed if he kicks that on at age 72. But what really sealed the deal was that he would be able to increase that income amount to $42,731 per year if he wasn't able to perform 2 activities of daily living, and that he would continue to get that $42,000 every year, forever, even if the client runs out of money, as long as he still needs help with 2 of those activities. So we gave him this great benefit with the GLWB rider that's been the hottest selling things in annuities over the last few years, along with this increased amount for long-term care. So if you're in a competitive situation with another advisor out there with income riders, sometimes this extra 50% to the client's account value for 2 activities of daily living will help you seal the deal. All right. Well, let's talk about marketing strategies here. And of course, what we try to do here at the Ohlson Group with our agents is really help you put together a full marketing plan, not just, hey, here's a selling system, do exactly as this other guy says and you're going to, make $1 million this year and sell $25 million in annuity premiums. Hey, we know everybody's different. Everybody likes to work their business a little bit differently, but here are a couple ideas that you can use to put into your practice to go make money right now. First of all, let's talk about this Pension Protection Act update. There are some great mailers and letters that we have that you can either send to current clients, that you can send out to anybody that's in your database, and we even have, through Kramer Direct, a Pension Protection Act mailer, which I believe is 49 cents a piece, so it's about $500 per 1,000-piece drop. That goes off. They're talking about, tax-free benefits for long-term care, and highlights, about the big buzzwords about what this Pension Protection Act does and how it just happened and just started January 1st. So it's a very timely issue here that clients don't really know about, and they're going to respond to this in order to talk with you, about this and see how it could benefit them. Annual reviews, calling up current clients and saying, hey, the new laws have changed here as far as how you can use your funds for long-term care planning. We need to get together and see if maybe this is right for you. A lot of our agents, too, are inserting this into current seminars that they're using. A lot of clients, a lot of prospects from the guys that do seminars with us that I've been told are booking appointments just because of wanting to learn more about the Pension Protection Act and these hybrid contracts here. For a lot of you out there, I can see on the list here for the couple hundred we have on here right now, a lot of you are doing this whole credibility direct mail program with us, where, to make a long story short, we have direct mail leads that go out through Kramer Direct, but instead of, when the clients respond to these postcards where they go directly back to you, then you have to call up the client, explain to them who you are, try to remind them about this mailer they responded to 7 to 10 days ago. What we do with this, the mailers come back to us at the Ohlson Group first. And what we do is we put together these credibility kits, which consist of a letter from you on your letterhead, some great brochures in there that explain what we do in our business, and of course we include a copy of the original mailer that they responded to remind them, hey, my name's Nick Ohlson, here's what I do in my business, here's a copy of the mailer you responded to, I'm going to be giving you a follow-up call within 48 hours of you receiving this package to set up an appointment. Our back office does all of that for you with sending out the credibility kits. And if you're on a run rate with us of doing a certain amount of business, we will match the cost of your mailers. We throw in $500 per month on top of your $500 investment on there. So this can work with these Pension Protection Act mailers that we have, in addition to some other mailers that they have that pertain to the annuity, life, and long-term care alternative marketplaces. Different things that have gone on with the government, with tax laws, and these new great products that we have out, and the Pension Protection Act, it's a great time to market these long-term care linked products. There are many types of different hybrid contracts for all types of clients that we've seen. Qualified accounts, non-qualified accounts, all different type of payment methods can work for you. And don't forget to use these new products and tax laws to bring old and new clients in the door. You know, just because you sold a $50,000 or $100,000 to a client, annuity that you have a client out there, it doesn't mean they don't have another 200 grand they didn't tell you about because you didn't bring up an issue that really resonated well with them. And of course, with these things like the Pension Protection Act and these new products, it's a great way to get people in the door that maybe your competitors are not talking about right now. So I do appreciate everybody being on this today. We welcome the opportunity to earn your business. I'm sure some of our marketing consultants will be getting in contact with you guys to see if there are any clients that you're dealing with right now that we can help you out with. If there are any of these marketing plans that you're interested in, please visit our website at ohlsongroup.com. You can see that below, and that's OHLSON group.com. And get a hold of us toll free at 877-844-0900. So what I will do now